Hello. Feeling a little bit sick right now, but I think I should do some options review since we have a few big events coming up this week. So let's see what the charts say. And let me pull up just the basic base money. Metrics. All right. So for let's say Friday's expiration, tomorrow this expires tonight. We have a bunch of put options. It's balanced. We have a lot of call options insurance for tomorrow, for Bitcoin, and for Ethereum. We have a lot of puts. So it looks like the market is bearish on Ethereum and bullish on Bitcoin, which makes a lot of sense since Bitcoin has been leading spot rally. And for the actual outlook, tomorrow will be somewhat a volatile closing. It doesn't look like there's a lot of interest actually on Friday, but the big one will be this one and really just the end of the month, which is mostly calls. So we're still looking at the skew. I think I mentioned it a few weeks ago where the market has been pricing upwards movement, and we have definitely gotten some upward volatility in the last few weeks, to say the least. For options, I think this is all right. So I think this is tomorrow. We got a big call wall at 2,500, which we already passed. So if we stay above that, we'll be squeezing higher, and that seems to be a really important level in conjunction with the 200 weekly moving average. So if we do go above the 250 or 200 weekly moving average, then these call options will hedge against any type of upside action for the people who are shorting this zone right here. And yep, a lot of buying, still a lot of call buying, and put buying for FOMC. So hedging into FOMC with puts and hedging in the end of the month. So I think that the only volatility that the option dealers are expecting is FOMC. So likely, the way I look at the market is 3 to 5 days before FOMC, market makers will withdraw liquidity. They don't want to be absorbing any price action, and so you'll see the price fall. And then they'll re-add liquidity after the event is going in, and then they're going to buy puts in order to protect against any type of downside market on their inventory. So that's something to be aware of. Like, why do we actually pump at FOMC? Is, well, there's liquidity being added back in the market after the market makers withdrew it from a volatility event. Hopefully that's not too complicated. That's base money. So for the actual volume of strikes, we are looking at 28,000 as a very key level. I have some point of controls at 30,000, and it's also sort of like closer to next range. And so the dealers look to be probably, and traders look to be buying around 28,000. So they're really betting on this level. And if the dealers do possibly get squeezed, they have hedged at 30,000. So between this area is kind of the likelihood. If we do, by some reason, cross 30,000, then we will swing fairly high up, because that zone is after the Lunaterra collapse, and it's quite illiquid, it's quite inefficient. So there's not going to be a lot of price stopping that kind of trend or momentum. That's, not saying that we will go there, but like, you should be open to the possibility that option traders would be squeezed and they're forced to be buyers at that level. It's similar to a short squeeze, which is like people are forced to cover their positions. Dealers who are selling call options are sort of like shorts in the way. They are forced to buy higher in order to hedge their position. So that's something to be aware of. And let me look at Levitas chain. Just go very basic little data here. I just keep it pretty simple because that kind of helps look at where a lot of the volumes of the options are placed. I'm just going to really concentrate on the FOMC because that's where they're buying things. And yeah, I mean, 27,000 is a good node, and so is 26. So that we should really be focusing that if we do have a pump after FOMC, that we could possibly tag these levels, and then these call options are acting as insurance to any market makers who want to be hedging themselves. Because I think one thing about market makers is that they're always buyers and sellers at the same time. So they'll need to buy options as insurance in order to protect against upside movement, right? Because that's not they trying to meet, like, the market will be imbalanced, and imbalances are not really good for market makers. They're great for like trend players and traders who want to act on a directional trend, but for market makers, they tend to be delta neutral. Because they're just both buying and selling on both sides of the book. So you have to recognize that when you're learning about options, you're thinking about like, where are people buying insurance because they are afraid of a move that's going to break a certain level. A while back we had a lot of put options actually bought at 223,500. Then you had a very large amount of gamma, and after that happened, we nuked all the way down because somebody knew that if this level was lost, they would need to buy insurance protection. And so that's how I want you to look both at call and put options, as someone's buying insurance options around this level, because if we do break above, and if you look at the chart, that move, the zone between 30,000 and 26,000 is very inefficient. So we could just clear right through it, slice right through it. And that's something to be aware of, especially if you are planning on shorting that level, that you should have a really tightened validation, because that market will cut through very, very fast. And so you should be aware of that. All right, that's all I have to say about options, and have a good day. I'll probably come back next 2 weeks after I get over this flu.